Think about everything you protect. Your home, your car, your family. Now think about the one thing you've never protected, the money you spent decades building. That changes today. This is the Insured Money Show with Shawn Graybeard Davis. Over 20 years of experience in financial services and the conversation that's about to change how you think about protecting your retirement. The Insured Money Show starts now.
You've been saving for 30 years. You've done everything you were supposed to do. You contributed, you sacrificed, you showed up, you did the job. And right now your money is spread across 5 accounts doing 5 different jobs, and none of them are talking to each other. And here's what nobody ever tells you. The problem isn't the amount. The problem is the architecture. Your money has been working one shift its entire life. And it's capable of working 7. Tonight, I'm going to take you up to the 30,000-foot view. I'm going to show you what it looks like when $1 protects your principal, grows without market risk, defers your taxes, locks in your gains every year, builds you a guaranteed lifetime paycheck, funds a long-term care need worth 3 times what you put in, and transfers cleanly to your family when you're gone. One investment, 7 paychecks. That's money density. And by the end of this hour, you're going to understand something about your money that most financial advisors never took the time to explain. I'm Shawn Graybeard Davis. This is the Insured Money Radio Show on KLBJ. Let's jump in. So I want to start tonight with one example that I think changes how you look at everything else we're going to cover. This one makes people sit up straight and say, all right, I'm listening. Imagine you walk into your bank and hand the teller $100,000 for a CD. You're going to put your money in a CD. The teller says, great, and just so you know, you came in on the right day. That same $100,000 will also, we have a special promotion. It's also going to cover $315,000 of long-term care if you ever need it. No separate policy, no separate premium, no separate application. It's like you read the fine print 3 times. But that is exactly what a specific type of financial instrument from insurance companies does. And most people have never been shown it exists. Here's why it matters. Think about this. A private room, a nursing home facility, private room in Texas nursing, runs north of $70,000 a year. And it's climbing. If you or your spouse ever needs extended care, that cost lands somewhere, either on a plan you built or on the money you spent 30 years accumulating that now is going to get exhausted because of your care needs. Most people haven't planned for it, and I understand why. Traditional long-term care insurance is expensive. And quite honestly, you hope you never use it. You hope you die in your sleep peacefully. The premiums can spike with little warning, and if you pay for 20 years and stay healthy, that money is simply gone. The deal doesn't feel right to a lot of people, and so most people skip it and hope for the best. What they don't know is that there is a completely different category of solution. Science hasn't figured out human cloning yet, but certain financial instruments have figured out how to clone your retirement dollar specifically for long-term care. The same dollar protecting and growing your retirement shows up as 3 if a care need arrives. Some people say, hey, Graybeard, listen, I don't know what you're talking about. How can you get $1 to look and act like $5 or $7 or whatever? I'm giving you an example right here. $1 in, so let me ask you a question. If you could bank with a bank and every dollar you put in, they gave you $3 in a separate account that you did not touch, $3.15. For every dollar you put into that bank account, they gave you another account that you couldn't touch unless you went into a long-term care facility. But for every dollar you put in, they put another account, $3.15. Why would you want to bank anywhere else if you got those ancillary benefits? So that's an example. This is one of the best examples I can give you of what it means to have money density, to have it figured out to where 100,000 in becomes 315,000 available somewhere else if you need it. That's not a math trick. It's a contract. $1 in gets you $3.15 of long-term care benefit. And oh, by the way, guaranteed issue. You're guaranteed to get the coverage. There's 3 ratings. You're guaranteed to get the coverage. Nothing else in financial services works that way. This is the concept of money density. Getting $1 to look and act like $5. All right, let me give you another one. Here's another one. My son's in the Air Force. Okay? And we're going to talk about the floor. All right? So here's the concept, the floor. My son's training to become a loadmaster, the person responsible for cargo, weight, balance, and safety of everything and everyone on the back of that aircraft. Part of his training happens in a simulator. And the whole point of a simulator is this. They can put you through the absolute worst case scenarios. Engine failure, total system failure, full crash sequence. I mean, when it's all over, you just open the door and step out. It feels real in the moment. It feels like you're really in that plane going down. But when it's over, you didn't crash. You open up the door, you step out, and you're standing on solid ground. You were never actually at risk. The crash happened around you. You experienced it. It did not happen to you. That is exactly what a zero loss floor feels like inside a fixed indexed annuity. Here's the thing about the stock market that most people understand intellectually, but don't fully reckon with emotionally until it actually happens. The market has no contractual obligation to protect your money. Zero. When you put money into a mutual fund, a 401k, or a brokerage account, you accept the full risk of loss in exchange for the possibility of gain. That is the deal. And when you're 35 with 30 years of runway ahead of you, the deal makes sense. You can absorb a bad year. You have time to recover. But when you're 10 years out from retirement, or 5, or already in it, a 30% market loss is not a temporary setback. It is a major math problem that can permanently alter the trajectory of your whole retirement experience. And the people who felt that most painfully were the ones who had done everything right. 30 years of saving, decades of discipline, all of it exposed to a single bad year at the wrong time. So this simulator example, the zero floor, if you could never lose money, if you could never ever go backwards, never lose ground, the zero floor changes that dynamic completely. When you put money into the right financial instrument, and this is the foundational job everything else tonight is built on, your principal is protected by a contractual guarantee from the insurance company. The floor is zero. The market can drop 10%, 20%, 30%, and your account value does not go down with it. You're in the simulator. The crash plays out. You open the door and you're still on the floor. You didn't crash. Now, here's what I want you to understand about why the floor matters beyond just protecting your balance. The floor protects your decisions too. When you know your worst year is zero, when the floor is guaranteed by contract by the only companies in all of our world that guarantee anything, which is insurance companies, you don't make panicked moves at the bottom of the market. You don't call your advisor in February of a bad year and say, "Get me out." You don't move to cash right before the recovery happens. The floor takes emotional decisions off the table entirely. And that is worth more than most people calculate. Studies consistently show that the average investor dramatically underperforms the very funds they're invested in because they make emotional decisions at exactly the wrong moments. The floor closes that gap. When zero is your hero, when zero is as bad as it gets, there's nothing to panic about. And the decision you don't make in a panic may be the most valuable thing a protected floor ever gives you. Zero is your worst year. Let that land. We are at all-time market highs right now. The probability is that we will face in the not too distant future some sort of adjustment to the market. If you are close to retirement, that can be catastrophic. If you're about to enter retirement, it can ruin your ability to stay retired. And that is the number one concern of retirees, outliving their money. And I saw this all the time. You know, let me catch up to speed. I managed money for 17 years. I had my own registered investment advisory firm. Part of the reason I got out of doing that, part of the reason I don't do it anymore is those types of calls. When the market would freak out, people would get concerned. They would get overwhelmed by emotion because money's a serious thing. A lot of people draw a lot of security from how much money they have. And when the markets were volatile, I would get people all the time that I knew I had to call, that I knew were going to be concerned, that were concerned about what was going to happen to their ability to either stay retired or get to that point. And so many of them, despite my encouragement, despite my suggestions, would then want to move money out of the market. Here's the point. There's a better way. You don't have to play the game. I mean, the simulator isn't a great example because during a crash, it's awesome. You're in the simulator. But let's assume that everything goes well. A lot of people think that annuities, fixed index annuities, don't credit as much, that they're going to underperform the market. In the next segment coming up, I'm going to talk to you exactly how that could be 100% wrong. that they could be better performing investments than pure market ones. But let me just say this. Retirement is very complex. It's a moving target. For example, once I sold my practice back in 2017, sold that practice, I found my way into owning an energy company. And I helped homeowners get solar for their home. Did a radio show. And I would talk to homeowners, and what was striking to me is I never, as a financial advisor, ever calculated double-digit rates of growth for energy costs as part of a financial plan. But that's what many people are facing throughout this country is double-digit rate growth on the back of artificial intelligence and what it's doing to energy demand. And so what I mean by retirement being a moving target is exactly that. All the variables are changing all the time. And if everything is changing all the time and all of your money is in a position where it can be impacted that way and changed over time, how do you have comfort in retirement? What I like about what I do right now is everything I do is guaranteed. And I've never, ever, ever had to apologize to a client for losing money via a fixed indexed annuity. Never done it, never will. Because they absolutely have guarantees. Guarantees, the only companies in the world that provide any guarantee language in anything anymore are insurance companies. They've been guaranteeing things for centuries. Okay? So here's what I would encourage you to do. If your money's all over the place, if you've got money everywhere, if you've got old 401ks, old IRAs, if you've got disconnected money, if your money isn't coordinated, if you're not getting multiple different benefits from it, if you're not getting $1 to look and act like $5, sit with me. It's worth a 30-minute call. It's worth a 30-minute conversation. It's worth a 30-minute appointment. Let me see if I can help you improve your density. Let's see if we can't get $1 to look and act like $5 for you. Here's how you would do that. Take out your smartphone, go to your texting app, key in the following number, 84503. And what I want you to do is I want you to text the word work. We want to get your money working for you. Kevin O'Leary, Mr. Wonderful from Shark Tank, he says his money's soldiers. He wants to have his soldiers go out and recruit more soldiers. Whatever way you want to think of it, soldiers or getting more jobs or whatever it is, let's get your money working for you harder than it is now. I have some vehicles. I have some options. I have some things that even have bonuses. We'll talk about that throughout this show. Imagine a signing bonus for signing on with an insurance company. I've got those. But all of the conversations start by you taking out your smartphone, go into your messages app where you send texts, key this 5-digit number in like it's a cell phone, 84503. Then all I want you to do is text work. Let's get your money working. Text work to 84503. And after the break in 2 minutes, we're going to talk about how much these accounts grow. Don't go anywhere.
You're listening to the Insured Money Show, and Graybeard is not done yet.
Welcome back to the Insured Money Radio Show. My name's Shawn Davis, but people in this town call me Graybeard. And before the break, I showed you zero is your hero. Zero is the floor, the guarantee that your principal cannot go backwards from a market loss. What we're talking about is getting your money to look and act like more dollars than what it is. Is there a way to get $1 to look and act like $5 in your retirement portfolio? I gave you an example in the last segment. I showed you how $1 invested into the right insurance contract, $1 that's linked for growth and retirement could turn into $3.15 of a long-term care benefit. Guaranteed issue, don't have to qualify. Best rating gets $315, middle rating $215, worst rating, you almost have to be in a long-term care facility. For every dollar you put in, you get $1.40 of long-term care benefits. So if any of this has appeal, if you'd like to get your money working harder for you than it is now, take out your smartphone, go to your messages app, key in the following number, 84503, and then just let's text the obvious. Work. Text work, W-O-R-K, work, because you want your money to work. 5 jobs, not 1. 7 jobs, not 1. Text work to 84503, and we'll get in touch. All right, so I know what some of you are thinking right now, because we talked last segment. The floor is the zero, right? Zero is your hero. If your money can't lose, then how does it grow? Hey, Graybeard, those safety. I don't like anything. I don't understand. And so, I don't know about these whole annuity things. That's a stretch for me. There has to be a ceiling on the growth to make up for the protection, right? So the most common assumption people make about any insurance products out there, the title of my show is Insured Money, right? They think that you never can grow money, that they're not good for growth. And that feeling is wrong. Not wrong in theory. There are some limits on how much you can earn in a single year, but the overall picture is dramatically different from what most people assume. So let me show you how this actually works, because once you understand the mechanics, the skepticism disappears. So picture a skybox at a football game. You're not on the field. You're up in the skybox. You're taking in the game. You're watching it. You're not taking hits. You're not at the risk of getting tackled, but when your team scores, you celebrate, you jump up and around, you high-five your friends, you laugh, you giggle, you're excited. You're connected to what's happening on the field without being exposed to the physical reality of it. That is indexed linked growth, kind of in one image. Now, here's what's happening behind the scenes in plain English, no jargon here. The insurance company takes a small portion of the money you give them, that you invest with them, and use it to buy what's essentially a market ticket. They buy an option on the market. Think of it like a ticket to the game where if your team wins, you collect a share of the prize. If your team loses, you lose the cost of the ticket. But that's it. The principal never touched the field. The ticket is the bridge between your protected money and the market's performance. So when the stock market goes up, you get some of the up. Like, for example, here's the analogy I like to use. Let's say the cap is 9%. And let's say the index is a S&P 500. So these types of products link your growth to whatever the index does. They'll buy an option on the S&P 500, in June of 2026. That option will then expire 1 year later, June of 2027. And if the S&P 500's up, they'll exercise the option because they have guaranteed gains. If it's down, they won't exercise the option. So they're out the cost of the option, but they won't exercise it. So think of it this way. It allows you to have 20/20 vision. You can look backwards and know every single time you exercise, you're going to make money, but every single time you don't lose money. You're just out the cost of the ticket. You're out the cost of the option. So the index, the S&P 500, a multi-asset index, whatever that produces, that's just a scoreboard. It's the measuring stick for how your interest gets calculated. You don't own the stocks. You're not in the market. The index tells the insurance company how much to credit you. That's it. It's like the barometer. It's like those whack-up. You ever gone to a carnival and they have those guys that hit that big old hammer and they hit it and it hits the thing and then the something goes up and it dings the bell. Ding, if you hit it hard enough. Think of the S&P 500 as a really tall barometer like that, and you got this whacking stick and you whack it, and then however high up it goes, it may not go all the way up to the top, but you get a lot of it. You get the gain. You don't ever go below. You don't ever lose the floor, right? So here's the part that surprises most people when they actually run the numbers. Most people assume that because an annuity has a floor, it's guaranteed, because it can't go negative, it must grow slower than a market account over time. The math, though, can say otherwise. A market account that drops 30% needs to gain over 40% just to get back to even. That recovery takes time, sometimes years, during which your money is not growing. It's just trying to survive and get back to where it was 2 years ago or 3 years ago. An account with a zero floor never has to recover from anything. The moment a good year comes, it starts compounding from the same place it left off. Over a 10 or 15 year window, the account that never loses. I want you to hear that. The account that never loses. I have the best job ever. I can look you in the eyes. I can call you. I can contact you. You can come see me. I can come see you. And I have accounts that never lose. Ever. I never have to apologize to you. The account that never loses frequently outperforms the account that wins big and loses big because it never stops moving forward. You're in the skybox. When the market performs, you earn. When the market drops, you sit that play out. Your money never took the field. I like that. I like being able to share that. All right, let's move on. Let's talk about an annual reset, because this goes hand in hand with this prior discussion. I want to talk about something that most market investors have experienced but never had a name for. You have a great year. Your count is up 15, maybe 18%. Feels good. The statement looks good. You go to dinner and you feel like you made a good decision. And then the following year, the market gives back 12% of that. And you're not just back where you started, you're actually behind where you started because the math of gains and losses is not symmetrical. Losing 12% of a bigger number costs you more than gaining 12% of a smaller number gave you. Volatility has a hidden price that most people never calculate. The losses are always worse than the gains. For example, in your head right now, I want you to do a little calculation, very quick. It'll illustrate the point. In your head, 100 grand. It loses 50%. How much money do you have? Then now that new balance gains 50%. How much money do you have? See, the average was you didn't lose anything. You went up 50, down 50, or you went down 50, up 50. But the reality of it is 100,000, lose half, down to 50, gain half, that's 25. Now you're at 75. You still have a real loss of 75. So hear this from me now. The losses are always more catastrophic than the gains. It always takes more up to make up for the down. So picture a truck driver securing a heavy load with a ratchet strap. You've seen those guys alongside the road, those big heavy straps. Every click, 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 it's tightening that strap. The load cannot slide backward. It cannot shift. It cannot come loose. And every time he ratchets it tighter, the previous clicks don't give way. The load only moves in one direction, tighter, more secure, more locked down. Every click is permanent. That is exactly what happens inside this financial structure at the end of every contract year. Whatever your account earned, whatever gain was credited, it locks. It becomes your new floor. The market cannot come back the following year and take it. It cannot drop and drag your gains down with everything else. They are permanently strapped down, yours, forever added to your protected base of money. Now picture a staircase, but this is not a normal staircase. Every step is a different height. Maybe one step's 2 inches tall. Maybe one step's 10 inches tall. Maybe one step's 18 inches tall. Maybe one step's 4 inches tall. Because every year the market credits something different. Some steps are big, some are small. Some years you stand on the same step because the market was flat or negative and you earn zero. But here's the thing about the staircase that makes it unlike any other in finance. You never step down. Every step only goes up or stays level, never back down. This is the only staircase in finance that works this way. And here's why it matters so much when you combine it with everything else we've talked about tonight. Your zero floor from job one means the worst step is zero. Your index linked growth from job two means the good years keep adding adding steps upward. And the annual reset means every step you climb stays climbed. You are compounding on a base that only grows. There is no volatility drag. There is no bad year erasing a good year. There is no recovery math. You simply keep stepping up, and every step holds. Wouldn't you rather that in retirement? People ask me all the time, why don't more people know about this? Hey, Graybeard, man, I never had anybody explain it to me that way. And the honest answer is that people who could explain it are usually in the business of selling something that doesn't have a floor, doesn't lock gains, and doesn't have a ratchet on it. You know, here's the biggest reason. I used to be a financial advisor. You know why your financial advisor most likely doesn't talk about this? Number one, they can't sell them because they don't earn a commission. Number two, they can't charge a fee on it either because there's nothing to manage. It's not at risk. They're not going to buy or sell it. So most advisors look past these types of vehicles because number one, they can't earn a commission. Number two, they can't manage it. It's not something that they're going to buy and sell. So it becomes a void for them. It becomes a place like it's like the black hole for them. I know because I used to be them. This is a different approach. If you like security, if you like guarantees, if you like the word guaranteed in anything on a contract, well, I'm your guy. So, best way to connect. Here's what I would say. Are you disorganized? Do you have your money in different accounts, sitting, acting like an entitled teenager, scoffing at the idea you wanted to do more than one job? If you want to get your money working, you need to do something different. And I'm raising my hand saying, I will sit with you. If you think you could benefit where I could help you get your money looking and acting like $5 or $7, then here's what you do. Take out your smartphone, go to your messages app, key in the following number, 84503. And I want you to text the one word that matters, the one word relative to this conversation that makes the most sense. Work. Let's get your money working for you. Let's get it working on guarantees. Let's get it working on growth. Let's get it working on never going backwards. It starts with you texting work. WORK to 84503. My beautiful wife, my high school sweetheart. We've been together, married 32 years, dated for 37 years now together, dated for 5 years before we got married. We got 4 incredible sons. She handles my calendar. She is my life partner. Her name's Jen. So when you text work to 84503, we're a small family office. There's only one of me. Only got so many days, only got so much time. So we are prioritizing those people that reach out that say, yes, I think talking with Shawn would be something I'd like to do. So text work to 84503. Coming up right after the break, we've covered the floor, the growth, the ratchet. Now I want to talk about the 2 jobs that work completely invisibly. Tax-deferred compounding and a guaranteed paycheck you can't outlive. One of them is adding money to your account every year that you don't even see on your statement. The other solves the one problem no investment account can ever solve. That and more, 2 minutes. Don't go anywhere.
You're listening to The Insured Money Show, and Graybeard is not done yet.
Welcome back to the show. We've been talking about money density on the Insured Money Radio Show. Do you have a way to get your dollars to look and act like $5? Can you get $1 to look and act like $5? Because our whole show, we've been talking about getting multiple possible benefits from the same dollar, getting guarantees, getting protection, getting growth, getting all kinds of different stuff with $1, making it look and act like $5. That's money density. And if you'd like to increase how many benefits your money is getting, if you'd like to learn more about insured money concepts and strategies, if you'd like to sit down with me, because my goal is to protect your money, grow it, and provide you as many guarantees as we can. All you got to do is text WORK, W-O-R-K, to 84503. Text WORK to 84503 so we can get your money working harder for you than you are for it. All right, I want to talk about job 3 here, and I'm calling it the invisible job because it's the one that's working for you in the background, whether you think about it or not. The problem is most people's money is set up so it works against them in the background instead. So here's the situation I want you to picture. You're sitting at a poker table. You have a good year. Your chips are growing. December rolls around and the dealer says, house rule, you have to cash out a portion of your winnings right now, pay the house their cut, and buy back in with what's left. You didn't need the money. You didn't need to take it off the table. You weren't planning to use it, but the rules say you pay the house every December regardless. That is exactly what happens in a taxable account. Every year your CD renews, you get a 1099. Every year your brokerage account earns dividends or interest, you get a 1099. The IRS gets their share whether you needed the income or not. And the money that leaves your account in April is money that never comes back. You not only lose the dollars, but you lose what those dollars could have earned you had you not had to pay it and you could have kept it yourself. A tax-deferred account, and this is the feature built directly into the annuity structure by the IRS tax code, not a workaround, not a loophole, lets you leave your winnings on the table. Every dollar that would have gone to the IRS in April stays in your account. It keeps earning. It keeps compounding, adds to that floor, adds to that step up we've been talking about. The house gets paid eventually when you actually take the money out in retirement, but in the meantime, every chip on the table keeps working for you. You got more betting power, right? Although we're not really betting because there's no way to lose money with this one. Now, here's why the timing of when the house gets paid matters so much. In retirement, particularly early retirement before Social Security is fully active, or in years where your income is lower, you have flexibility to choose when you take distributions. You can take money out in a year when your tax bracket is lower and pay a smaller percentage to the house. In a taxable account, you have no choice. The 1099 arrives every December, whether the timing makes sense for you or not. So I want to put one number on this so it becomes real without making you do the math while you're driving. Take $100,000. Put half in a taxable account and half in a tax-deferred account. Same growth rate, same everything, except the taxable account, the gains get taxed every year, and in the tax-deferred account, they don't. Over 15 years, the difference between those two accounts on the same starting balance can exceed $35,000. Not because you contributed more, because one account let the winnings ride and the other one cashed it out. $35,000 of difference from doing nothing differently except where your money sits. That is job 3, invisible, automatic, and completely dependent on having your money in the right structure. Most people are sitting at the taxable table cashing out every December, and they don't even know there's another table available to them. That's the reason why we do this show. All right, moving on. I want to ask you something, and I want you to be honest with yourself as you answer it. How long do you plan to live? Nobody knows, right? That's the honest answer. And that unknown, that open-ended question of how many years you'll actually need your money to cover is the single biggest financial risk in retirement that gets the least amount of attention. We talk about market risk all the time. We talk about inflation. We talk about interest rates. But the thing that actually devastates the most retirement plans is something much simpler. People living longer than their savings were designed to support. A healthy 65-year-old today has a meaningful chance of living into their late 80s or early 90s. If you retire at 65 and live to 92, that's 27 years of retirement. Most retirement savings plans were not sized for that. And a market account that's drawing down over 27 years while also absorbing the occasional bad market year, the math, the money gets uncomfortable fast. Your grandfather probably didn't have this problem. He had a pension. Every month, a check arrived. Didn't matter what the market did. Didn't matter how long he lived. The check came. It was a contractual obligation from his employer that could not run out. And for the people who had them, pensions solved the longevity problem completely. Companies stopped offering pensions decades ago. They shifted the risk to you through 401ks and market accounts. The responsibility for funding your own retirement and making sure it lasts as long as you do became entirely yours. Most people accepted that shift without fully understanding what they gave up. So in other words, the whole worry about running out of retirement money has been born in the last 50 years. It's a function of employers moving to 401ks, making you manage your own money, which you're not a money manager. Most people are equipped to do other things in their life. They're not that. People 50 years ago, 60 years ago, 70 years ago, they never worried about it. They got guaranteed income. They never worried about running out of money because the company paid a pension. So here's what I want you to know. You can build your own pension. The right financial instruments lets you accumulate money with a growing benefit building in the background, one specifically designed to become a guaranteed income stream when you're ready to turn it on. Think of it like a personal pension growing behind the scenes while your money is also doing jobs 1 through 4. You don't touch it, you let it build. And when you flip the switch, when you want income at 65, at 70, or whatever point makes sense for your plan, a guaranteed monthly check begins. And here's the part that separates this from every other income strategy available. Every other one. The clock, the check does not stop. It does not run out. It does not depend on what the market did last year. Your account balance could drop to 0 and the check keeps coming because it is a contractual obligation from the insurance company that continues as long as you are alive. You cannot outlive it. Think about what that changes. When you have a guaranteed income floor, a check that you know is coming every single month, no matter what, you stop rationing your retirement out of fear. You stop wondering whether you'll run out of money at 83. You stop making conservative spending decisions in your most active retirement years because you're afraid of the future. The guaranteed check gives you permission to actually live your retirement, not just manage it. You can build your own pension. That option exists. Most people haven't been shown how to do it. I can show you how to do it, but here's a little pension history, just so you know. Thousands of years ago, the Roman army rewarded soldiers who served 20 to 25 years with either land or a cash payment upon retirement. This gave soldiers financial securities after the war. At the same time, Roman burial societies pooled contributions so members' funeral costs would be covered. The idea was risk sharing. In medieval Europe, something called risk pooling came about. Merchants shipping goods across oceans faced enormous risks. Italian merchants developed marine insurance where many traders contributed premiums into a common fund. If one ship sank, the pool compensated the loss. This was the birth of the insurance principle. Pool risk, predict losses, promise payments. During the 1600s and 1700s, mathematicians began studying mortality. A guy by the name of Edmund Halley, better known for Halley's Comet, created one of the first accurate mortality tables in 1693. This changed everything. For the first time, insurers could estimate average life expectancy, how many people would live at each age, and how much money was needed to pay lifetime benefits. This gave birth to actuarial sciences. By 1700, companies began selling life insurance. People paid premiums while alive. If they died, beneficiaries received money. Someone eventually asked, though, an important question. Instead of paying money when I die, what if you pay me while I live? That question created the modern annuity. Instead of protecting against dying too soon, it protected against living too long. Then by the late 1800s and early 1900s, large employers began offering pension plans. One famous example was American Express, which introduced the employee pension in 1875. Railroads, banks, and manufacturers followed. Employers promised, work here for decades and we'll pay you every month after retirement. Insurance companies often help fund or insure these pension obligations. Throughout the 1900s, insurance companies became institutions best equipped to provide guaranteed lifetime income. Why? Because they already specialized in mortality statistics, long-term investing, risk pooling, lifetime guarantees, and reserve management. But here's where everything went wrong. Back in 1978, implemented in 1980, the 401k was born, and the shift away from providing you a lifetime income. See, here's the thing that you need to know. You go back 50, 60 years, people that retired didn't worry about running out of money 50, 60 years ago because they had a company paying income to them for the rest of their life. All of that changed in 1981. All of it changed. The birth of the 401k shifted the responsibility to you to save, to pool your money, and then pensions disappeared. And then the market came. Everyone says the market's where you got to be. Well, if you want lifetime income, if you're worried about running out of money in retirement, the only vehicle out of anything out available today that would guarantee you a lifetime income is an annuity. It's a private personal pension. If this is at all making sense to you, if you'd like to have guaranteed income, if you'd like to sit down with somebody that has a different perspective on the retirement equation, I want you to be guaranteed. I want you to be safe. Some of you may be effectively retired right now and you might not know it, but you're concerned about market risk. Your strategy is off. Here's what I'd offer. 30 minutes with me. Let's figure it out together. Let's take a deep dive into what you're doing. Make sure you're getting velocity, density on your money, right? We want to increase the density of your money. $7 for every dollar in. If that has appeal, take out your smartphone right now. Go to your texting app, key in the following number, 84503. And what I want you to do is I want you to text the following word, work. Just text work, W-O-R-K, work, because you want your money to work harder for you. You want your money doing 7 jobs instead of just doing 1. If it's sitting in a CD, it's got 1 job, safety. If it's in the market, it's got 1 job, growing, right? We want you to have 5, 6, 7 jobs for your money. So if you take out your smartphone, we initially communicate with our audience via text messaging, small family boutique office, okay? I've been in the business for almost 30 years. My wife handles my calendar. Her name's Jen. We're high school sweethearts. We've been together for 32 years, married 37 years since we first started dating. We have 4 incredible sons. And if you want to work with somebody that thinks outside the box, has different resources, and wants to get your money working harder for you than you're working for it, then one last time, if you take out that smartphone, go to your texting app. This lets us know that you out in Radio Land want to be contacted. All you got to do is text work to 84503. Again, text W-O-R-K on your smartphone. Go to your texting app, key in that 84503 number. Like it's a cell number. I know it's only 5 digits, but I promise it'll work. But key that in, text 84503. And coming up next, in 2 minutes, I'm going to close out the show. We're going to pull it all together. Don't go anywhere.
You're listening to the Insured Money Show, and Graybeard is not done yet.
Welcome back to the show. You're listening to Insured Money, hosted by myself. My name is Shawn Davis, but people in this town call me Graybeard. And we've been talking about getting your money to work harder for you than you do for it. Shouldn't your money have 3, 5, 7 jobs while you just have one? Well, here's what we can do. If you'd like to get your money working harder for you than you work for it, text WORK. W-O-R-K to 84503. It's called money density, the idea that your money can have multiple jobs at one time, providing multiple different benefits to you through strategic investments. Text WORK to 84503 if you want to sit with me, have a 30-minute conversation with somebody that thinks outside the box. One last time, text WORK to 84503. All right, so here, getting into job 7. Job 7 is the quietest one. This is the 7th job I've outlined throughout the whole show today of what your money could be doing that it may not be doing now. Now, it doesn't generate excitement on a quarterly statement, the 7th job. It doesn't make headlines. It's not the reason most people choose this strategy, but it's the reason the strategy is complete. Here's the question I want you to sit with for a minute. When you're gone, when your life is done and everything you built over 30 or 40 years is sitting there, where does it go? And more importantly, how does it get there? If your money is an IRA or 401k, your beneficiaries inherit more than an asset. They inherit a tax obligation. Federal law now requires most non-spouse beneficiaries to draw down an inherited retirement account within 10 years. And every dollar they pull out comes out as ordinary income, taxed at their rate, in their bracket, in the years they're drawing it. The financial gift you left them comes with the strings the IRS tied on. If your money's in a brokerage account, it goes through your estate, potentially through probate, which means a process, a timeline, attorney involvement, your family navigating all of it at the worst possible time. Assets that could transfer cleanly get caught in a system that was not designed with your family's convenience in mind. Now picture something different. Instead of leaving a pile of cash on the kitchen table for your family to sort out, imagine leaving an envelope sealed, addressed, right person's name on the front. When you're gone, they make one call. They provide documentation. The insurance company honors the contract you set up, and the transfer happens clean, directed, exactly as you intended. This is how direct beneficiary transfers work. The remaining value in your account goes directly to your named beneficiaries. Outside of probate, by contract, without the process. You designated who gets it and in what proportion. That designation is honored. Your family does not need an attorney to unlock it. They do not wait for the court. They get a check. So I want to be honest about what Job 7 actually is. You're not buying a death benefit in the traditional sense. You are simply acknowledging that every asset has to go somewhere when you're done with it. The annuity structure ensures that it goes exactly where you said it should go, not where the process sends it. That distinction matters enormously to the people who come after you. You spent decades building something. You protected it. You grew it. You drew from it wisely. And when you're finished with it, Job 7 makes sure it goes straight to the people you love in a sealed envelope with their name on it. No confusion, no process, no delay. And that's the 7th job. And together, all 7 running simultaneously on the same dollar. That is what money density actually looks like at 30,000 feet. So before I let you go tonight, I want to pull all 7 of these jobs together. And I want to paint you a picture. Not an abstract financial picture, just a real one, because this is where everything we've talked about tonight stops being a concept and starts being your life. Let me read the 7 jobs that we've discussed this whole hour one time slowly. Job 1. Your principal is protected. The floor is zero. The market crashes around you, not on you. You open the door and you're standing on solid ground. Job 2, that same protected dollar is linked to market growth. You ride the up. You sit out the down. Same destination, none of the wreckage. Job 3, every gain stays on the table and compounds tax-free. You stopped crashing out every December. The winnings keep earning. Job 4, every year's gains lock permanently. The ratchet holds. The staircase only goes up. You never give back what you've already earned. Job 5, you built your own pension, a guaranteed monthly check that doesn't stop, no matter what the market does, no matter how long you live. Job 6, the same dollar shows up as $315,000 if you need long-term care and you qualify at the best rating. No separate policy, no separate premium. Your retirement dollars clone for one risk most people have left completely unaddressed. Job 7, when you're done with it all, what's left goes to your family in a sealed envelope with their name on it. No process, no lawyers, no waiting, a check. $1, 7 jobs. That is money density. Now, I want to take you somewhere for a minute. I want you to picture your retirement. Not the retirement you're worried about, the one you actually want. Picture it like this. What if it could look like this? Picture a morning where you wake up and the first thought in your head is not, I wonder what the stock market did last night or yesterday. Picture a month where the bills come in and you don't flinch because a guaranteed check arrived on the first and it covered everything. Not some of it, everything. Your mortgage, your utilities, your groceries, your insurance, every recurring obligation you have to drive your lifestyle, to live the way you want to live, covered by a check that is contractually guaranteed to keep coming for as long as you are alive. That is what your own personal pension looks like. And here is what it feels like. You stop worrying about running out, not because you crossed your fingers and hope for the best, because you built a floor so solid that running out became mathematically impossible. The check comes every month, forever. That is not a projection. That is a contract. Now, here is the question I want you to sit with, because this is the part most people have never thought all the way through. If your guaranteed income covers everything you need every single month, what happens to the rest of your money, the stuff that's left over, the money that you didn't have to use because your income's already covered every month? Think about that. Most people in retirement are trying to do two things at once with the same pile of money: grow it and protect it simultaneously. They're holding back from the market because they can't afford to lose what they need to live on. Being conservative with money, they wish they could be aggressive with because there is no floor under their income. Every dollar is at risk because every dollar might be needed. But what if your income needs are already fully covered? What if you have money left over every month that you genuinely do not need to live on? That money, any excess money, gets liberated. It doesn't have to play defense anymore. It can go to work fully, aggressively, without the fear that losing it means you can't pay your bills. When the floor is guaranteed, when your nut is guaranteed, when the amount of money you need to have coming in every single month is guaranteed, everything above it can take on risk and more growth potential. The floor takes care of survival. Everything above it takes care of growth. Most people assume this kind of instrument is the conservative choice, the safe, boring, give up the upside choice. What I just described is the opposite. A guaranteed income floor doesn't limit your growth potential in retirement. It unlocks it. Because when your floor is covered, when your monthly income is covered, the rest of your money finally has permission to run. I want to show you what that picture looks like with your specific numbers, your balance, your income needs, your timeline, 30 minutes together, and we build it from scratch. 92% of retirees worry about running out of money. Imagine what it would feel like if that worry never entered your mind. The freedom of how you could enjoy retirement. See, because when everything that you've got is market-based, when all of your accounts, your 401ks, your old IRAs, all that stuff, and many of you out there, you have this concern. You've talked to your advisor, and I would say 85% of advisors out there really don't have a formal plan for you. They just say, trust me, it's going to be okay. Yes, you've got enough, but you sense, you fear, there's something in you that says, God, I feel like there should be more. How do we make sure it's guaranteed? How do I make sure I have comfort with it? I can show you that. I can help you drive that personal pension plan with guaranteed income. And that's one of the reasons why I do Insured Money. See, I've lived as a financial advisor for 22 years. I managed other people's wealth. I understood the limitations. I tried to get people diversified much more substantially. I rode the markets up and down. I was in financial services back when the dot-com bubble burst. I was in it in 08, 09. And the reality of it is tremendous fear and overwhelm and anxiety took hold with a lot of retirees in both of those major market falls. And here the market is at all-time highs, never been higher before, and we're sitting out here thinking that can't happen again. Well, absolutely, it can happen again. So here's what I'm going to close out the show saying. If you want to get organized, if you want to look at the 30,000-foot view of what you've got, and if you want to marshal your money to work harder for you than you're working for it, I can help. Sit down with me, no obligation, 30 minutes. You can do so by taking out your smartphone right now. You can let us know you're out there in Radio Land. All you got to do is text the word work because we want to put your money to work. We want to guarantee your income. We want to cover your basic expenses in retirement. We want you to be somebody that never, ever has to worry about outliving your money when everyone else, 92% of retirees, are worried about outliving it because we put a strategy together that covers your fixed monthly expenses and a little extra. That frees up all of your money that is market-based to just run, to work and just run and to grow. That's your hedge. That's the excess. That's the fluff. That's the extra. If that says appeal, text WORK to 84503. One more time, text WORK to 84503. Now, before I let you go, coming up next week, I'm going to have a full show dedicated to that long-term care strategy I just mentioned earlier, getting $1 to look and act like $3.15. We're going to do a deep dive on that next week.
That's our time for today on the Insured Money Show with Shawn Graybeard Davis. The money you've spent a lifetime building deserves to be protected, not just managed. Thanks for listening. We'll talk again next week.